On the morning of March 3rd, 2026, the most searched financial terms on American internet platforms were not the names of Iranian military commanders or the casualty figures from Kuwait. They were Dow Jones and Federal Reserve. This is not a trivial observation. It is a precise signal about where the American public, and by extension, the American political economy, has located the center of gravity of the conflict's consequences, not in the Persian Gulf, in their portfolios, in their retirement accounts, in the interest rate on the mortgage they are refinancing, or the car loan they are carrying, or the credit card balance they have been meaning to pay down since the rate environment improved. The Dow Jones Industrial Average is a machine for aggregating the collective judgment of professional investors about the future earnings of the American corporate sector. When it sells off in the context of a Middle Eastern conflict, it is not expressing an opinion about military strategy. It is expressing a precise actuarial judgment that the conditions created by the conflict will reduce corporate earnings, compress consumer spending, and deteriorate the macroeconomic environment in which every publicly traded company operates. That judgment, on the morning of March 3rd, is correct. But the more consequential signal embedded in the search trend data is not Dow Jones. It is Federal Reserve. Because what millions of Americans searching for the Fed on March 3rd are implicitly asking is the question that sits at the center of this analysis. What is the most powerful monetary institution in the world going to do about the economic damage this conflict is inflicting? The terrifying answer, the one that no official statement will communicate clearly and no market commentary will state directly, is that the Federal Reserve cannot do anything about it, not because the Fed lacks tools, because the tools it has were designed for a different class of problem. And the problem that a missile over the Persian Gulf has just delivered to the American economy is not a problem that any tool in the Federal Reserve's arsenal was designed to solve. To understand the invisible financial mechanics connecting a blockaded strait to your investment portfolio, your mortgage rate, and the purchasing power of every dollar you earn, and to stay ahead of the macroeconomic shifts that this conflict is engineering in real time, make sure you are subscribed to this intelligence network. What follows is the anatomy of a checkmate. The Federal Reserve's mandate for price stability and maximum employment is operationally implemented through a single primary instrument: the federal funds rate, the interest rate at which banks lend reserves to each other overnight, whose level propagates through the entire financial system to influence borrowing costs, investment decisions, consumer spending, and ultimately the price level and employment rate of the U.S. economy. This instrument is extraordinarily powerful against one specific class of inflation. That class is demand inflation, the condition that arises when an economy's spending exceeds its productive capacity, when more money is chasing the same or smaller quantity of goods and services, and when rising prices reflect the gap between what buyers want to purchase and what the economy can produce. Demand inflation responds to interest rate increases because raising the cost of borrowing reduces spending. Consumers borrow less to purchase homes, vehicles, and durable goods. Businesses borrow less to fund investment and expansion. The aggregate demand of the economy decreases. The gap between spending and productive capacity closes, and price pressure is moderate. The Fed's 2022-2023 tightening cycle, the most aggressive rate increase sequence since the Volcker era, worked precisely because the inflation it was combating was substantially demand-driven, fueled by the combination of pandemic-era fiscal stimulus, supply chain disruptions that created temporary shortages, and the subsequent demand surge as economies reopened. That tightening cycle produced the outcome its architects intended. Inflation returned toward target. The economy slowed but did not collapse, and the Fed entered 2026 positioned to begin normalizing rates back to levels consistent with a healthy, growing economy. The supply shock delivered by Operation Epic Fury and the IRGC's Hormuz closure is not demand inflation. It is not caused by excess spending or by too much money chasing too few goods. It is caused by the physical unavailability of an input, crude oil, that is required to produce, transport, and deliver the goods and services that the U.S. economy consumes. When crude oil at $100 per barrel raises the price of gasoline, heating fuel, airline tickets, trucked goods, and manufactured products, whose inputs include petroleum derivatives, those price increases do not reflect excess consumer demand for those products. They reflect the mathematical reality that producing and delivering them now costs more because the energy required to do so costs more. The distinction between demand inflation and supply inflation is not semantic. It is the difference between a disease and its treatment being the same thing, and a disease and its treatment being categorically incompatible. For demand inflation, the treatment, raising interest rates to reduce spending, directly addresses the cause. For supply inflation, the treatment, raising interest rates to reduce spending, does not address the cause at all. The Federal Reserve cannot print barrels of oil. It cannot reopen the Strait of Hormuz with a rate decision. It cannot reduce the cost of crude by making money more expensive to borrow. What it can do by raising interest rates in response to supply-driven price increases is reduce the spending power of the consumers and businesses that are already being taxed by higher energy costs, compressing demand in an economy that is slowing not from excess but from deprivation. This is the first blade of the stagflation trap. The second blade operates through the same instrument, pointed in the opposite direction. If the Federal Reserve, observing a slowing economy and rising unemployment, responds by cutting interest rates to stimulate growth, it introduces additional liquidity into an economy whose price level is already being pushed upward by supply constraints. Cheaper borrowing means more spending. More spending against a supply-constrained economy means higher prices. The inflation that was already being driven by the energy supply shock is now amplified by the monetary accommodation intended to soften the growth impact. The currency depreciates against the inflation signal. Import costs rise further, including the cost of the alternative crude supplies that the U.S. and its allies are attempting to source from non-Gulf producers. And the inflationary spiral that the Fed was trying to avoid by cutting rates is instead accelerated by the cut. The Fed, on the morning of March 3, 2026, faces a policy matrix in which every available action produces a bad outcome and inaction produces a different bad outcome. Raise rates, deeper recession without price relief. Cut rates, higher inflation without meaningful growth support. Hold rates, neither stimulus nor restraint, passively absorbing a supply shock while both growth and prices deteriorate. This is checkmate in the precise chess sense of the term, not a difficult position with clever moves available. A position where every legal move leads to a worse position for the moving side. The historical precedent that illuminates this trap most precisely is not 2008 or 2020, the two crises that dominate the Fed's recent institutional memory, and that its current toolkit was calibrated to address. It is 1973, when the OPEC embargo quadrupled crude prices within 3 months of its imposition. The Federal Reserve of that era faced a structurally identical policy dilemma. Its initial response, holding rates steady and then cutting to support a slowing economy, validated the inflationary signal and contributed to the wage price spiral that embedded the supply shock into the core inflation rate for the remainder of the decade. The eventual solution, the Volcker shock of 1979-1980, which raised the federal funds rate to above 20%, broke the inflationary cycle, but produced the deepest recession since the Great Depression, with unemployment peaking above 10%. The Fed of 2026 cannot replicate the Volcker solution even if it chose to. The United States entered the current conflict with a federal debt level exceeding $30 trillion. The annual interest expense on that debt, at the rate levels prevailing before the conflict, was already the fastest growing line item in the federal budget. A Volcker scale rate increase, a move to interest rates of 15, 18, or 20%, would increase the federal government's annual interest expense by hundreds of billions of dollars, compounding a fiscal deficit that is already structurally unsustainable without military emergency spending added to it. The fiscal dominance constraint, the phenomenon whereby a government's debt burden becomes so large that central bank independence is effectively compromised because sufficiently aggressive rate increases would trigger a sovereign debt crisis, is not a theoretical risk for the United States in 2026. It is the binding constraint on Fed policy that prevents the only historical solution to supply shock stagflation from being deployed. The aha moment in this analysis, the insight that restructures the entire framework through which the March 2026 conflict should be understood, is the recognition that the IRGC's Hormuz closure is not only a military tactic, it is a financial weapon. And its design reflects a sophisticated understanding of the asymmetric cost structure of modern monetary warfare that the channel's preceding analysis has been building toward since the first video in this series. Consider the cost-exchange ratio of the Hormuz closure as a financial weapon. The IRGC's capacity to close the Strait of Hormuz to commercial traffic through a combination of explicit closure declarations, demonstrated willingness to fire on transiting vessels, and the consequent withdrawal of commercial insurance that makes legal transit impossible, does not require continuous military expenditure. It requires the maintenance of sufficient military capacity and command authority to make the threat credible. In the fragmented post-decapitation environment of the Iranian state, that credibility is provided not by centralized military planning, but by the demonstrated reality that IRGC units with access to anti-ship missiles will act on the closure declaration regardless of whether any central authority is coordinating them. The closure costs Iran, in marginal military expenditure terms, very little beyond what the preceding conflict has already spent. What it costs the United States and its allies in energy market disruption, in Asian manufacturing contraction, in central bank policy paralysis, in consumer purchasing power erosion, and in the political economy, pressures that sustained stagflation generates, is measured in trillions of dollars of foregone economic activity and monetary policy capacity. This is the asymmetric ledger of the Hormuz closure applied to monetary policy specifically. A physical blockade that costs its implementer nothing in marginal terms has stripped the most powerful central bank in the world of its primary policy instrument's effectiveness. The exchange ratio is not 3 to 1, as in the interceptor economics analyzed earlier in this series. It is incalculably higher, because the damage being inflicted is not on a military asset with a replacement cost, but on the monetary policy transmission mechanism of the global reserve currency, whose impairment propagates through every interest rate-sensitive market in the world economy. The hidden tax dimension of this financial weapon is equally precise in its incidence. Energy price inflation, as documented in the preceding analysis, is the most regressive form of price increase, falling most heavily as a proportion of income on the lowest income households, whose consumption budgets are most energy intensive and least substitutable. But the monetary policy paralysis compounds this regressivity through a second channel. In a healthy economic cycle where the Fed has policy space to cut rates, lower income households benefit from lower borrowing costs, cheaper auto loans, more accessible mortgage financing, lower credit card rates that partially offset inflationary pressures. When stagflation eliminates that policy space, the rate relief that would partially compensate for the energy price tax never arrives. The regressive energy inflation and the foregone rate relief compound simultaneously against the households least equipped to absorb either. The hidden tax of the Hormuz closure on the American consumer is therefore not a single levy. It is a double levy. Higher prices and higher borrowing costs that the Federal Reserve's checkmate prevents it from addressing through the only mechanism it possesses. The aha insight that this analysis delivers to the viewer who has followed this series from its beginning is the recognition that the Fed's helplessness against the March 2026 supply shock is not a failure of institutional competence or policy design. It is a structural consequence of a global energy architecture that was built on the assumption of uninterrupted physical supply from a geography that is now a combat zone. The Federal Reserve's models, the dynamic stochastic general equilibrium frameworks, the Phillips curve specifications, the Taylor rule variations that translate economic data into policy prescriptions, are built on datasets collected in a world where the Strait of Hormuz was open. They incorporate energy price volatility as a stochastic shock with historical mean reversion properties, a temporary disruption that the model expects to resolve as prices signal to producers and markets to adjust. They do not incorporate the scenario in which the physical infrastructure required for mean reversion, the tanker fleet that would normally respond to high prices by increasing supply, the insurance market that would normally price the risk and allow trade to continue, the sovereign authority that would normally respond to economic pressure by modulating its closure posture, has been structurally disabled by military action and state collapse simultaneously. The Fed's models are not wrong. They are simply calibrated for a world that no longer exists as of March 3rd, 2026. The deeper truth that the checkmate metaphor illuminates, and that policymakers on both sides of the Atlantic are confronting without any precedent adequate to guide them, is that geopolitical sovereignty and monetary policy independence are not separate domains connected by loose correlations. They are the same domain, viewed from different analytical perspectives. A central bank that operates in an economy dependent on energy imported through a geography controlled by adversarial military forces does not possess the monetary sovereignty that its institutional charter implies. Its policy instruments function only as long as the physical supply chains those instruments are calibrated to influence remain intact. When the physical supply chains are severed by military force, the policy instruments do not fail gracefully. They generate bad outcomes regardless of which direction they are deployed, because they are calibrated for a physical reality that no longer obtains. Energy independence is not, therefore, a commodity policy goal, or an environmental policy goal, or a trade competitiveness goal, though it is all of those things. It is a monetary policy prerequisite. A country that depends on imported energy flowing through contested geography does not have full monetary sovereignty. It has conditional monetary sovereignty, sovereignty that holds under the condition that the geography remains navigable and the supply uninterrupted. The Federal Reserve discovered the conditionality of its sovereignty on the morning of March 3rd, 2026, when its policy matrix collapsed to 3 options, and every one of them was wrong. That discovery will shape monetary policy doctrine, energy security investment, and strategic planning frameworks for decades. The checkmate was delivered by a missile, but its consequences will be measured by central bankers, not generals. And its lesson, that the physical infrastructure of energy supply is the foundation on which monetary policy sovereignty rests, is the most important macroeconomic truth that the Persian Gulf conflict of March 2026 has forced into the open. The Federal Reserve's models will be rebuilt to incorporate this truth. The energy security frameworks of every economy that operates a reserve or major currency will be revised in its light. And the cost of learning it, in inflation, in foregone growth, in monetary policy credibility, and in the purchasing power of every household whose financial life depends on a central bank that has been stripped of its instruments, will be paid for years. That is the price of the checkmate. And it was set not by the Federal Open Market Committee. It was set by the geography of the world's energy supply, and by the military decision that made that geography a combat zone.